Well, hi everyone, and welcome to the Buffett and Beyond Stock Analysis video podcast with your host, Dr. Joseph Belmonte, which is me, and Debbie with a Y. Hi, Debbie. How you doing today?
That's me.
And these analyses are based on the book Buffett and Beyond, second edition, published by ORLY Publishing. And we're going into the auto parts industry, and this is always considered a recession-proof industry. I'm not too sure that the stocks don't go down when we have a recession. But people buy more auto parts during a recession because they want to fix up those old clunkers rather than spending the money, which they don't have, to buy a new car. So here we go. And the first one is Advanced Auto Parts. Debbie, what's this company all about?
Well, like you said, Advanced Auto Parts, and the stock symbol is AAP. Advanced Auto Parts is one of the nation's largest retailers of auto parts and accessories, and it operates roughly 5,044 stores in the U.S., Puerto Rico.
A lot of stores.
Yeah, a little bit. Puerto Rico and the Virgin Islands under various trade names like Advanced Auto Parts, Advanced Discount Auto Parts, Discount Auto Parts, and Western Auto, as well as 131 WorldPac branches. The company serves both the do-it-yourself and the professional installer markets, and it's acquired Discount Auto Parts in 2001 and has about 71,000 employees.
Wow, pretty big company. And one thing I want to bring out before we go forward is that these companies are all going to sound familiar. So the only way that we have to differentiate one from the other is the numbers, which we are about to go over. And then at the end, we will compare all three companies side by side, and we will predict which companies will probably do better going into the future just by looking at these numbers. So here we go. And looking at the clean surplus return on equity on Advanced Auto Parts, and we can see that this company had a nice high clean surplus return on equity. And remember, to get into our growth portfolio, we want to see a company that has a 20% clean surplus return on equity. And remember, the clean surplus return on equity is totally different than the traditional accounting return on equity. And when we use the clean surplus return on equity, I want you to think of your bank account, because the clean surplus return on equity has a correlation, a pretty good correlation, with how the company will perform going forward under normal market conditions. So when we look at the clean surplus ROE, think of money you are putting into a bank account that it's earning that percentage interest, and you want to go to the bank that's going to pay you the highest return on your interest, and that's what this return on equity is all about. So looking at clean surplus return on equity for Advanced Auto Parts, we see that it had a nice high ROE back in these early years, and then it went down all the way down to 10.1% last year, and now that ROE is starting to climb. So we have a little quandary with this company that had a nice high ROE, then it went all the way down. And remember, the average stock in the S&P 500 has an ROE of about 14.5%. So this stock was a great outperforming stock years back, and then it fell down to below an average stock, and now it's starting to creep up again. Now the market likes an increasing return on equity because that means the earnings are increasing at an increasing rate. Think of a race car that's going faster and faster and faster rather than at the same speed. So we look at this ROE of about 14% projected for next year. This year, 11.9%. Folks, that doesn't wow us at all. We don't even have to go any further with this stock. We would not put it in our portfolio, not because it's not a good stock, but because there are a lot other better stocks out there. And how it performed over the past year, well, it did pretty good. It's up about 80% in here over the past year, while the market is up about 13-14%. So it has done very, very well over this past year. But when we look at 5 years, we can see it's performing just about as well as the market. And folks, this is a pretty volatile stock. Look, it's been all over the place, and it is performing exactly as the S&P, even over a 5-year period. So it's really still not our kind of stock. So let's go to the next one.
All over the roadmap. Well, the next up is AutoZone, and that stock symbol is AZO. And AutoZone is the leading retailer and distributor of the automotive replacement parts and accessories in the United States. It operates 5,465 stores in the U.S. and Puerto Rico, 500 24 stores in Mexico, 14 stores in Brazil, and 26 IMC branches. And each store carries an extensive product line for cars, sports utility vehicles, vans, and light trucks. And they have over 84,000 employees.
Wow.
These are big companies.
Yeah. And let's look at the numbers. Now, doesn't this sound like a lot like Advanced Auto Parts? I mean, the description, the number
Sure
of stores,
does.
number of employees. Okay, so let's look at the numbers, and we can see that the clean surplus return on equity has been fairly consistent over the past 5 or 6 years, higher than the average stock in the S&P 500, which again is 14.5%. So this stock is nice and consistent here, and we used to have this stock in our growth portfolio because look again down here, this stock for many years had an ROE of over 20%. So we had this stock, but as that ROE started to fall, we took this stock out of our portfolio and we replaced it with another stock, which we're going to see in a second. But recently it's got a nice ROE, a consistent ROE. The market likes that. However, it's not that 20% that we're looking for. So let's go and see how this stock performed over the past 1 year. And again, it's right down here about 17% for the year. And it is still outperforming the S&P 500, which we would expect because the S&P 500 with the average stock at 14.5 clean surplus ROE. This stock has a 16% clean surplus ROE. We would expect it to outperform the S&P 500. And over 5 years, well, it's over here, folks. It's up about, I would say 70%, while the market is up about 60%. So it is slightly outperforming the S&P 500. So with the higher clean surplus ROE, this company is outperforming the S&P 500 and it is outperforming Advanced Auto Parts that has a lower ROE. Now let's go to the last stock in this industry, and it's O'Reilly Automotive. Debbie, take it away. What does this company do?
All right, O'Reilly Automotive, stock symbol ORLY. O'Reilly Automotive supplies aftermarket auto parts, tools, equipment, and accessories to both do-it-yourselfers, customers like myself, well, in the old days, not today, but anyway, and professional.
Debbie used to race cars.
I used to drag race after I rebuilt my car engine, but I don't know anything about the engines today. And anyway, the customers and professional mechanics or service technicians, and they also offer services including used oil, battery recycling, wiper bulb replacement, and operates 5,019 stores, 27 regional distribution centers in 47 states, has about 75,000 full-time and 30,000 part-time employees.
Okay, so again, this sounds like the other companies. So we don't know how to differentiate these companies unless we look at the numbers. And this is not like horse racing, folks. When you go to the track and you pick the jockey with the best colors, you pick the nicest sounding name for a horse. This is not the way you do it when you select stocks. It's a whole different situation here. So let's look at that clean surplus ROE, and ooh, we see that this thing has had a nice 20% ROE all these years, projected to fall down to 19% for next year. But guess which one of these stocks we now have in our growth portfolio? Yeah, it's the one with the higher ROE. Yeah, so we can look a little bit further here, and we can see that the net income growth and the revenue growth have pretty nice numbers in here for 2019. It's got low debt. Years to pay debt is 1.2. Now, Buffett's rule of thumb is that if a company can take all of its earnings and just use it to pay debt, if it could pay its debt off in 5 years or less, he likes that company. He feels the debt is very manageable. This company can pay its debt off in 1.2 years if it took all the money it was making to pay the debt. So this company, we look at it and we say, we don't have to worry about that debt at all. It's not paying a dividend, which we like in a growth stock because we want this company to take all the money it's making and put it back into itself in order to grow. And this clean surplus ROE with a consistent 20% ROE means that the company is getting the same profit margin on the newly invested capital. In other words, the earnings that it's putting back into the company, it's getting the same return as it did last year and the year before and the year before. So the profit margins are staying up there as the company grows. Now let's look at how it did in the past 1 year. Whoa, it's up 60% while the market is up about 10%. So, folks, it looks like this stock is outperforming the other two stocks, and it should because it has a higher clean surplus ROE. Looking at 5 years, whoa, it's up about 160%, while the market is up 60%. That's almost 3 times the market. We like this stock, folks. And let's put the 3 stocks together. So we have the S&P 500 with about a 14.5% clean surplus ROE on the average stock. Now, O'Reilly for 2019 has a 19% ROE, AutoZone 16.6%, and Advanced Auto Parts 14%. Folks, it doesn't take a genius to know that 19% is higher than 16%, which is higher than 14%. So looking back, we would expect O'Reilly to outperform AutoZone. We would expect AutoZone to outperform Advanced Auto, and we would expect AutoZone to outperform the S&P 500 by a little bit, and Advanced Auto to approximately perform as well as the S&P 500, with O'Reilly outperforming these other 2 companies going forward. Now let's look at the past 5 years. We can see the black line again is the S&P 500, and this red line up here, yeah, that's O'Reilly, way outperforming these other companies because it has a higher ROE. If it has a higher ROE, that means it's making more of a profit, and the market says, I want a stock that's making more of a profit than a stock that's not making as much profit. It's that simple. Think of your bank account. I want to go to bank account O'Reilly and put my money there, and that's what the market has done. Now we come down here, the blue line is AutoZone, which is the second best performing here, which has the second best numbers, and that's what the numbers are telling us. And then this rusty colored line is Advanced Auto Parts, slightly outperforming the S&P 500. And again, this S&P 500 is the black line. So when we look at the numbers, we see that O'Reilly has the highest numbers. Folks, that's the one we would put out of these 3. That's the one we would put in our portfolio. It's that simple. You look at the numbers and you pick the ones that's returning the best return on equity, because the clean surplus return on equity is a comparable number that we can compare one company to another, while the traditional accounting ROE is not. And that's what the book is all about, folks. So if you want more information on that, go to the site. If you want more information on that, then you go and read the book.
Read the book. Well, JB, I think we've just about covered all the questions sent in by our listeners out there in investment land. And remember, folks, we're here to answer your questions, not only about individual stocks, but also about the stock market in general. So keep those questions coming, and who knows, we may even answer a question or 2 you didn't even know you had. That's about it for today, JB.
Okay. Now, folks, don't forget, if you want to receive free a full month of all our letters and complete access to our computer program, just to go to our site and sign up. Remember, all you need to manage your own portfolio is in this free subscription, and it's free. Just go to BuffettandBeyond.com, and Buffett is spelled with 2 F's and 2 T's. That's BuffettandBeyond.com. Okay, folks, we had a great day today.
And tomorrow will be even better.
All right, bye, folks. We'll see you next time.
Bye, everyone.
If you want to live at the beach like Jimmy Buffett, you got to learn how to invest like Warren Buffett. All right, folks, we had a great week this week. You have a safe weekend, and we'll see you next time.